All right. We're killing time. First couple minutes here. Walter, Tyson, Peter with no camera, disrespectful in the background, but we're gonna work through it. But we're here for episode 3 of Venture Research Roundtable, which somehow came up really fast. I'm pretty sure we did this last week, but it's monthly cadence, so that doesn't make any sense to me. But with that, cast of characters. If you haven't been here before, you definitely get too many emails from me, so I'll stop that. I won't stop sending the emails, but I'll stop with the intro. More importantly, the gang, Walter, as handsome as ever, running Sacra Private Research, has a great new report we're going to go over for a company called Glean that you've maybe heard of. And also we'll end up talking about some Y Combinator stuff that Walter has some war stories from that he likes to bring up. Similar to me, having not gotten in. And we'll talk about, Hill's general take on private markets and what he's seeing on his side. And this is the wrong slide. And Tyson, again, also looking more handsome than Walter due to the suit. Running Notice has some good private market data on the buy and sell order side, where we're seeing some decoupling. Fancy word. I'll let him explain. And finally, our resident influencer, Peter Walker. Great insights. Feeling spicy today because his camera's not working. Doesn't have to look us in the eye. And with that, we'll get into it. Let's see. I'll pull people up here. Then Tyson, and Peter last because he's the worst.
Do we want to spend the next 15 minutes critiquing that intro? Yeah, man, that was rough.
No, we don't, because I would love to, but we got stuff to get into, Peter, and I'm trying to keep this professional, unlike some people.
Whoa!
In their underwear off camera.
Thanksgiving week, man. Cut me a break.
Yeah, this is a working week. Private markets don't sleep. Markets always open.
Private markets don't sleep.
Literally, private markets are the only market that sleeps.
Private markets don't
like
sleep
years and then stuff happens.
Except for like tomorrow until like end of January, and then mid-July till mid-September. But besides that,
I'm gonna start a GoFundMe for you to get the tattoo. Private markets don't sleep.
Private markets don't sleep
on your back.
My Gordon, my fake Gordon gecko.
His lower back.
Lower back. Yeah, for sure.
Yes.
Yeah. Florida resident, jokes on you. That's super cool here. But it's good to have the gang back together. If anything, I enjoy this, so I don't even care what the viewership looks like. It's actually good, generally, because I spam people with the email about it. But the run of show here, very loose run of show. We won't be critiquing the intro. Don't have time for it. Tyson's going to show us some data from his side, just as a monthly check-in on where things are. There's the Notice Top 50, but then also some new hot companies, and then that segues into some research from Walter. Just nothing from Peter because he's on vacation, and some YC commentary from all of us because the batch is coming up next week. We'll talk about the move from 2 to 4 batches, that is, and we'll see where things go from there. So, Tyson, you want to kick us off?
Sure. Yeah. This is great. I'll kick it on that GoFundMe, by the way, Peter. So just let me know when that's up, and
yeah,
I'm into it, man.
Venmos have already been sent to all of you.
Isn't that what
I think?
Isn't that there like some crypto GoFundMe type thing? It was a pump.fun or something. Have you guys seen this? It's like a crypto bull cycle. So like people are like launching meme coins and record days. And there's some platform where there's like live streams happening where people. You guys haven't seen any of this? Maybe it's just my Twitter feed. I was crypto rich once upon a time. It didn't last. And
what happened? Yeah,
this is a different story. I hodled.
Oh, lame, dude.
True believers. But anyways, they like stream. They stream stuff like, if this pumps to $10, I'll get a lower back tattoo. It's like,
yeah.
And but it's like crazy. It's like some guy's been like sitting on a toilet for like a week or something.
It's just Twitch meets shitcoins.
Is this
That's
what?
like it's Twitch meets shitcoins.
Yeah, exactly.
It feels like
Twitch.
the purest
yes.
expression of 2025.
I haven't
Yes.
seen anything like that in this Y Combinator batch, but I think that would have done well. I'm surprised I didn't see that on the request for startups, Twitch for whatever. I used to give that pitch on the stock side back in the day, but neither here nor there. Tyson, how's going?
It's going great. I mean, I feel like this is it's going to be a real easy segue into looking at a stock chart. But no, this is good stuff. Let me share, and we'll just talk quickly about the trend, and then we can kind of go from there.
Tyson, it actually does fit though, because like everyone's buoyant optimism about next year is what's driving Adam's lack of money and everybody else's actual money. Everyone seems, I don't know about you all, like pulse on the room. Everyone seems like they're trying not to be super hype about 2025, but they definitely are. They're like, oh yeah, once this year turns, things are going to get back to whatever, back to
2021.
Really good. Yeah. They don't want to say it. They're all like couch it and like, well, it's looking like, or we're cautiously optimistic, but I haven't heard one person who's like 2025 is going to be worse than 2024.
Right. Well, I mean, maybe we'll start seeing some crazy rounds again. You know, you'll be the first to know. You'll be the first to know
We'll
that.
start seeing crazy rounds because we haven't been in like crazy rounds before. I guess outside of the AI stuff, and maybe this is where, because obviously the AI rounds have been crazy, but I feel like we have there's some fintech. I feel like the fintech companies, like fintech gets hot when like obviously like markets get going. And there's a company that I like a lot that we're investors in, but After Hour, they do like, it's like Wall Street Bets, but like an app like version and better, where there's like real trades or whatever. And they've definitely seen, everyone's like flooding in. And same thing with like when Coinbase is running ads again, like like things are moving.
Yeah, big strong signal, buy signal.
Yeah.
Yeah. Coinbase ad budget inversely related to a lot of things. Cool. Well, yeah. So can you see my screen? Is it up?
No, it's not. I don't.
Huh.
Let me see.
Yeah,
I have seen the After Hour founder blowing up on Twitter, which is normally a negative sign. So I'm glad to hear they're doing well. Like this guy's doing too much thought leadership.
No, consumer, man, consumer. It's different.
Nice. Well, so this is since we last talked. This is a month ago. I had to ask before we started because I felt like it was 2 weeks, but it's been a month. Blue line here is our 50 company index, and just to refresh, it's 50 of the largest actively traded and kind of sought after buyers or sellers in the secondary markets, private venture-backed companies. And so this index gets reconstituted quarterly, and you'll see I've got the IPO ETF, the triple Qs, and the S&P 500. And this is over the last month, and you can see that it's, it looks like, I don't know, maybe we've been talking about kind of risk on mentality. It seems like it may be playing out here. I mean, the two best performers of these four over the last 30 days is the private market index, which is speculative and illiquid, and then the IPO ETF. So, there's that. But then I think the broader thing is looking at this over like a wider time frame, right? So if we go, this is back to the middle of 2020, right? So I'll focus this down a little bit because it's kind of messy. So let's just look at this versus the NASDAQ. Okay, so things got a little bit crazy in 2021, as we talked about last time, a little bit, and then there's kind of this come back down to earth, and then there's some parity, and you're starting to see things diverge again. And I'm just curious to see how this plays. Does it kind of keep decoupling, or do we see it come back to reality again? It's hard to say. I mean, I don't think there's anyone out there who's like, oh, the public markets are undervalued. Like I don't know that anyone's really saying. Maybe there are like super AI bulls, but it doesn't seem like there's been a huge pullback or anything. But still, you've got the private markets like way exceeding.
Tyson, is it? You said that the blue here is top 50, right?
Top 50.
So is it what's the weighting? Like what percentage of the outperformance or the crazy bump was actually like 2?
Totally. Yeah. I mean, I can try to, let me see here. So basically, I don't have a way to isolate okay, I can tell you what the effect is. So basically, the largest performers, the largest components are OpenAI, SpaceX, ByteDance, Stripe, right? And so then it goes down from there. So these are going to have a disproportionate share of the impact, but I don't have their 1 month return. So I can't tell you how much of this in the last month was them.
Yeah.
We can look at them individually. I think we should actually probably do that because that would be really cool.
But it's still like you're talking top 5 names are 40% of the weighting, something like that, right?
Yeah, top 5, 35.9%. So it's a similar rule set that the triple Qs use to keep their situation, the modified market cap index. So we'll do special rebalancings when things get out of control or if they get out of control. But yeah, the top 10 are basically half.
My question on that is like, okay, what if things go as bullish as some of the big bulls expect next year, and we get crazy lucky and 3 out of those top 5 names on your board IPO? Like, then if you're just looking at private versus public, do things actually feel almost identical? I'm just wondering, like, how much of this is, hey, we're waiting for Stripe and we're waiting for SpaceX, and like those have infinite demand, really.
I see.
Versus the actual layered demand for names 20 through 50 is not quite as high.
That's definitely true. I mean, the demand it's a bit of a power law on the demand here, right? Like there's the markets for the 20 through 50 are much smaller and much more intermittent for these names. But I don't know. I mean, I don't know that. I mean, I guess, are you saying that is it possible the public markets are lagging here because they're waiting for these things to IPO, or that there's just so much demand trying to jump into such small allocations here that it's driving things up? I'm not exactly sure.
I guess my point is, like, there's been a lot of discussion about how there hasn't been a bull case made for IPO in a while. But my instinct is that we're talking about a very exclusive set of companies who could remain private indefinitely with tons and tons of capital. And that situation doesn't actually apply to most names. So really, like, my instinct is that as soon as the IPO market looks pretty good, we may see more IPOs than we think, because it's actually harder to stay private than people expect if you're not one of the top 5 names.
Sure. Yeah. Especially if you're having difficulty attracting capital because the largest in your sector are making investors swear to not invest in you if they invest in them. That makes it harder.
Or if you have crazy liquidation preferences a la Service Titan, which I don't know if you all saw the Meritech breakdown there, but it's like, it doesn't look like you're IPOing because you want to.
Brutal.
That's rough.
Yeah, definitely.
And
definitely
so I guess
not good.
And the comment, Peter, is more like, just because that is decoupling doesn't mean the rest of the private markets are seeing like some big bullish signal.
Completely. Yeah. It's like you're talking about how power law is this power law.
Yeah. I mean, I think that, and you probably have better data on this than we do, but I think from a general field perspective that it is directionally correct. Like, I think the fact that, whatever, Bitcoin hitting all-time highs and like NASDAQ ripping and all those things. Yes, there are like drivers of that, and there's people that are left out of it, but it's all degrees of up rather than like, oh, this is up, but this is way down. I think that, I don't know, that seems to be the general feel, and just the general, and you mentioned like the being more optimistic about 2025 and just the general outlook for 2025. I do think that like trickles down into the market sentiment generally, whether you're thinking about investing in AI or you're thinking about investing in something that's less hot than AI. It's not as prominent. It's not like as much of like, holy shit, like this is ripping, but it's still more than it was. I think the fintech example, like the after hour, like the fintech example is an interesting one where like fintech was like not cool for a while. And up until like very recently, it feels like that shifted. And I wonder, and again, like Peter, I feel like you probably have better data on this. And it sounds, you were saying, I think you're starting to put together stuff for the end of year, but my gut there is that things it's not as much as like it's not going as well as like OpenAI is going, but it is still generally going in like an up direction, or at least better than it was. Even if it's still down, it's not as down as it was.
Yeah, and I think it's a lot like the Magnificent Seven's impact on like the SPY or something like that. These larger companies that are attracting a lot of the attention and the capital are driving a lot of the returns in the private markets, just like they are in the public markets. So I think it's very similar.
Yeah.
There's also probably, a broader conversation there about like when you bet on power law, and I've been thinking about this like and I think maybe Palantir is an interesting example of this in the public markets, right? Where it's like, as soon as a company starts to show signs of like, oh, this company is going to be like the future or whatever, all of those future earnings get like pulled up so fast to like be like, oh, now they're already there. Like they still have like the grow into your valuation bit, right? Where it's like, well, they're going to grow into it, but it gets pulled up so quickly that, and this maybe like loops back to what Peter was saying about the IPO aspect, where it's like, they don't grow all the way into it. They still want to get liquid. It gets really ugly because like a lot of founders who get put those, they show signs of success and then they're, evaluate. It takes a lot of discipline to be like, no, we're not there yet. And maybe this is ironic, but I feel like SpaceX actually does this a little in private markets, where it's like, if SpaceX was a public market company, I think that it would be like so insanely more expensive than it is today, because they like just like artificially control price with tenders, right? They artificially are like, even from last tender to this coming tender, I think whatever it was, like low 100s, like 110 or something like that, to like 135. Like Trump is like buddies with the president now about like getting the rules taken down so we can launch more rockets. Like in a public market scenario, I think that you'd see like Palantir type, like, oh, it's worth 10x what it was before, even though that's not how revenue is scaling, even though they're doing like super well. So I don't know. Yeah, I think that there was, I'm reading that that new Boom book by like the Stripe press release. I don't know
it's good, man. It's good. Yeah. Did you hear about it through Ben Thompson as well?
I saw it on, I'm definitely like a Stripe press like nerd. I just generally think that their stuff's cool. But I saw it on Twitter, the usual like tech thought leader types, me being an aspiring one of them, following along. But they touch on this type of thing, right? Where like the dynamics are all pretty crazy.
I'm not going to take Stripe seriously until they drop Stripe Press, as a line of business. Like these guys haven't really contracted enough yet if they still have Stripe.
They're supposing the books are so cool, Walter.
Yeah, they're cool.
Walter, are you anti-reading? Make your case.
It's when a company has I watch for when companies have vanity publications, much less vanity book presses with cool bindings, and then when they drop them, when they're like, okay, this was a dumb idea, we shouldn't have done this in the first place. That's when they're like, sanity has prevailed.
I feel like the time for that to happen has come and gone with Stripe.
We're back to bull.
That was like 2 years ago. Stripe was maybe it got brought up. Like,
is that like back when Airbnb had like a glossy travel magazine for a while?
Yeah. And Mercury has like a publication that I haven't checked in with. Let's see.
Is it still going?
What do you think of Robinhood? Robinhood has like 4 media publications.
Robinhood they brought Snacks,
and then they bought Charter, which is like data graphics for journalism that like lives in Snacks now. So, and they've been seeming to rip, Walter. I don't know. That might be the counter.
I don't know, Walter.
Yeah. Fair enough. I'll take a look
off camera.
Maybe it's barbell. You got to have at least 4 publications or 0, right? Like if you're in the middle, it's like you're not committed enough to the strategy.
I was told by many anonymous Twitter heads that all SaaS or all media, like the best media publications, are going to live within SaaS companies. So maybe I was wrong about that.
Well, the one that's doing the best is Carta, obviously. So
clearly, yeah.
To bring it back down, we're talking about like kind of top movers in the late stage stuff. From the Notice side, Glean was a new big company that got pulled up into the stratosphere, and into like and I think one of the interesting parts about Glean, and you have just purely from like a market side, and Tyson, you'll probably have good commentary on this, is like a company going from totally illiquid to like regularly talked about, regularly traded. Like, I think that, like, when it moves into the like outside of the top 50 or whatever to inside of the top 50, and how different the liquidity levels are there. And I don't know specifically on Glean, but I know that it wasn't in that world, 6 months ago. It wasn't, people weren't talking about trading in and out of Glean. But that's come up like over the course of the last month, right?
It has, yeah. There was a funding event a couple months ago, and we don't know the specifics of the price per share. I'm sure Peter could just pull it up on Carta real quick and let us know. But that hasn't been filed in the documents yet, so we don't know. But yeah, there's definitely been a lot of activity that's come up since then, and people are chasing it.
And Walter, you guys put together a report, didn't you?
Yeah.
Pull that up. Did you get some juicy revenue data for us?
Yeah, for sure. So yeah, let me share my screen. So yeah, we published this report, I think last week. Glean at 100 million in recurring revenue. And I think one of the interesting things, I didn't realize this, not having followed Glean carefully. I always kind of wrote Glean off as like a fake company, but I think that was mistaken.
You think I was wrong?
Just to be clear. So I didn't realize they actually pre-existed. Like they were founded, I think, in 2019. So they've been around for a bit, and they started as like enterprise search, basically like you connect all your, you connect everything, you connect your docs, like your, all the different apps you use, and then you can do search over them. And this is kind of like a AI company. But then obviously when, LLMs came around, they were able to turn that sort of like search into, similar to Perplexity, like actual, like, it's like pulling together those resources, creating sort of net new content with that, being able to chat like with your documents so you can learn more. And so, launched in 2019, took them 3 years to get to 10 million, which is not short, but not like really long, obviously, but not like incredibly fast, like some of these companies are. But then, 4x and then like another 2.5x, getting to 100 million, like this year. I mean, it's pretty insane. They're growing really quickly. And then it's kind of like part of it, there's here. So let me, we put together just like these comps with like some of the others in the space, like Hardej, and then and Writer. Writer's an interesting one because their approach is they have an LLM, so they built the foundation model and like the sort of enterprise app on top, which is kind of interesting. And we have them trailing a bit, but they've been growing pretty quickly because only as of like 2022 they were like 2 million ish, which is like nothing. So I mean, nothing relatively speaking. That's still bigger than Sacra, just to be clear. So it's interesting to see the space, and then like there are very large corporate players in this space. So like obviously Microsoft Copilot, Gemini, and then like Dropbox announced Dropbox Dash recently, which is like enterprise search over all of your docs, all of your files. And so there's a lot of activity. So it's an interesting space to be in. And yeah, Glean, I mean, to see Glean kind of like emerge as like the leader on the sort of like startup side is cool. The other thing is like part of the founding team came from Rubrik. So it is one of the handful of companies that have gone public recently. So
oh, interesting.
Yeah.
I got to hit up the Augment guy.
Yeah. That's what we were doing. Is like, hey, like we want to talk to Glean, and so Noel was texting with them.
That.
Is Writer even like? Are these all? Is Writer playing in this space as like a document tie-in? I thought they were just more like copy and stuff. Maybe I missed.
Yeah, so I think it's like basically they're like sort of converging on this sort of like enterprise AI. I mean, it's pretty high level, but enterprise AI, like from different directions. So Writer is more like like marketing copy, but they're the same concept, which is basically like, how do you, like, everyone in your company should be using AI, but it's like how, and there are different modalities. So basically, generating content, searching, and like retrieving information, and there's just like sort of like a handful, of things, and basically those things are kind of like coming together, even though they're coming from different angles. Like, and sorry, the third one is probably like automation app builder. So like Heavy is like more of an app builder, and there's like sort of like playing similar spaces like Airtable and Zapier, both of which like have like Airtable's obviously gone enterprise. Sure. So it's like kind of like
would you count something like Gamma in this as well, in terms of depth and like content creation, or is that not really the vibe?
I think Gamma less so. I think Gamma's more like it was obviously started around Dex, but then like creating like single serve websites and that kind of thing. So I think if you think like Gamma is still like PowerPoint, like an app in the productivity suite, and then there's kind of like the Microsoft Copilot of the productivity suite. It's like kind of like two separate things.
I think that, I didn't necessarily understand this about Ryder as much as I did, but they're definitely, despite their name, much more like all encompassing. Like the name of it made me think it was more, I don't know, single feature focused and less like in the Glean category.
Ryder. So like, the kind of like OG generative AI companies that blew up were like Jasper and Copy AI. And Jasper, like Copy AI now has like switched to more of like a go-to-market platform. Ryder was like the third, like kind of like the third that like didn't grow as quickly, but then they've like pivoted more to like enterprise AI. But it's interesting because Ryder the whole time, like they raised a mega round at like $1 billion without really having that much traction, but I think they did on the back of like this concept that they are also a foundation model company, which is kind of interesting. But I think it'd be semi-harsh if someone from Ryder was watching this, but I don't know anybody who uses their foundation model, I guess aside from potentially using Ryder. So, it's anyway.
Well, okay, wait, Walter and Tyson, you run companies. Do you use any of this stuff?
No.
Enterprise. I don't know if Sacra enterprise.
Well, okay. Well,
Sacra doesn't
Peter,
get enterprise level stuff.
So, Peter, you know that Carta has a Ryder testimonial.
Indeed, we do.
So wait, you use Ryder? Yeah. So tell us.
Well, we've played around with it. I haven't used it a lot, to be honest. We've used a lot of internal AI tools. I don't know if we've really adopted an enterprise solution. Maybe we're behind.
Yeah, well, a lot of, obviously these companies have real revenue, but early on, a lot of their like testimonials and case studies were obviously there was a good article that came out, which is like, you've got ARR, right? You've got like revenue, right? Then you got like ARR, annual recurring revenue, and then this guy coined the term ERR, experimental recurring revenue. So like what his idea was like a lot of the sort of like traction that we're seeing is actually like companies not really doing long-term contracts and not really like real recurring revenue. Is more like, let's sign up and experiment with this product and maybe we'll spit out a case study. So like when you see like testimonials and case studies on people's site, it's not necessarily like enterprise-wide like true deep like adoption. It's like you have to like actually talk to people and see who's actually using it. So
I have a good data point, a very it's actually probably my highest like biggest tech connection, like one of the few windows I actually have in like big tech spending. And a guy I was reconnecting with, and we were talking about where they're spending their money on the AI side and like what's coming up for this coming year. And I think that one of the insights that he shared was that in 2024, I think that this goes with a lot of companies, a lot of these big enterprises like bought up a bunch of different shit. They were like, sure, we'll try this, we'll try that, we don't want to get left behind. And at 2025, and so all these companies then raise money on top of exactly what you're describing, right? Where it's like, yeah, people got the contract, but that doesn't mean that it's like they're going to renew in 2025. And a lot of these big tech companies and a lot of these big contracts from this, anecdotal, but definitely like notable, someone who actually kind of knows what's going on inside, was we're going to cut a ton of fat in 2025. Like, because we're super game to try, like we have plenty of money to try stuff out. We'd rather overspend in 2024 and actually know what we want in 2025. And so it'll be interesting if that plays out in a broader way where exactly what we're talking about, like whatever the Gleans, the writers, and, you know, even some of the bigger ones, like even like the Anthropic and OpenAIs of the world, where people signed big 1-year contract or big, like, yeah, get it in house. Let's not miss on this. But now it's like, you know, those contract cycles are coming up, and it's definitely not a given that people are going to keep it. And so 2025, in that way, it sounds like on the, like, you know, the big tech spending timelines will be like on the chopping block for like, this was cool, but I don't think I got this much value out of it. Or this was cool, but we actually like this other thing. And there's a bunch of people, right, like competing for that sort of.
So 2025 is going to be the year of AI churn. Is that what you're saying? Enterprise AI churn?
Yeah, you can quote me
is
on
that.
that.
Your column?
Okay. I think that the 2025, I think that is, will have more like trimming of the fat in the space, right? Where it's like everyone.
Will that help us figure out who the actual winners are going to be? Like when you start seeing people cut these, like, oh, well, these were kind of nice to try. You know, I mean, a lot of the Sacra charts for AI companies are just like massively up and to the right, like just crazy, right? They're all like, oh, we're growing 1,000,000% a year. You know, like, are we going to start just figure out like, oh, after a couple quarters, it looks like these guys have leveled off or they're declining, so they're basically just out the back, and good luck to them? I mean, that'll be interesting to see.
Yeah, there was some good research on this topic of basically it's like, you know, now, like, I mean, this is not actually true what I'm about to say, but, you know, figuratively accurate. Just like, you know, it's like AI disappointment, you know, is like trending. You know, so it's like, you know, people were like positioning for AI and everyone was signing up, and now everyone's disappointed. So, you know, given that, you know, contracts lag that, you know, maybe we'll see, you know, churn, good amount of churn in 2025. And I think, you know, I think that would be healthy. But long term, obviously, you know, AI is like incredibly useful and valuable. It's just like, and like still like incumbents who are incorporating it, you know, are doing it in really useful, you know, helpful ways. I think the bigger question is just like, which startups can like, you know, build something durable. And yeah.
Well, I think it goes back to the general power law kind of nature of all this stuff, where it's like you don't need 10 different solutions for, like, you know, the same problem. And so like all these different, so there's, you know, maybe 10 different options. They're all kind of like making their way. One, you know, is doing a little bit better than the other ones, or like, you know, delivering a little bit more value than the other ones. They survive, other people die out. And then, you know, one company, you know, the winner takes most type of dynamics across, like, you know, you don't need a million different enterprise search options. Like you don't need, you know, the enterprise AI. There doesn't need to be 50 enterprise AI companies. There probably needs to be a few, but then, like, you know, the consolidation, and then like how the, you know, this company had an okay experience, this one had a great experience, they keep it, the other one dies, and then the other one lags into, you know, whatever it might be. Maybe it's Writer or Glean or whoever. Yeah. But yeah, so that was the big, and the numbers that this, you know, my unnamed source, it is crazy. Like the amount of money that a lot of this, like, big tech put into like not missing AI on like this, you know, the experimental contracts aren't like, you know, a YC, you know, friends contract, like throw some MRR at a startup like to try it. Like these are, you know, hundreds of millions of dollars of, we'll try it out type of there was a good, that Bill Gurley and the Altimeter Guy podcast talking about, like, if you're a big tech company that prints money, like there's only a few options of like what you actually do with that, right? Mm-hmm. Where you can, you know, stock buyback, a dividend, or CapEx spend, right? And so like CapEx AI spend seems like a pretty easy option of like, sure, like $1 billion here, $1 billion there. Let's try some stuff out and not miss. I don't need another $1 billion sitting in my bank account, and like no one cares about our dividend. So like, let's buy another tool. But yeah, so I think 2025 could be a big like party of the ways on the, at least maybe on the I think agents are like probably maybe some of like the new thing, and maybe there's another like cycle that like, kind of mass all of this, but on the like new tools and like up into the right crazy growth revenue, it seems like that's the prevailing storyline. The other thing I mentioned, the YC stuff, that was the kind of the last topic that we had, or actually one thing that I wanted to share, because it kind of ties into the IPO stuff, and some of the a former thing that we had talked about in terms of like, the private company staying private, going public, like information being a big issue. This came up today on the back of, there's been a couple of things like floating around in the Twitter sphere today. One was the generalist did the mullet capitalist post came out where they're talking about like basically like new venture models where you have to be like more service driven. He talks about media stuff a lot, but there's like actual services like recruiting or things like that. And then Alex put this out about the next big content play for VCs about basically helping founders like tell their story on a regular basis. And like, the weekly news. I don't think that this is how it'll play out. Like, I don't think every founder in the country will do a weekly newsletter, or that it's a huge value add for a founder to have like a ghostwriter that helps them do a newsletter. But this feels like a small data point in the larger, like, private companies sharing more about what they're doing early on in their life cycle, like being more vocal about like the build in public thing, but in a little bit less like hackery and a little bit more like, we're a real venture-backed company and like we're sharing regular updates on like product as well as revenue, as well as like where our growth trajectory is. And that ultimately leads into a more liquid private market, right? The big difference between private markets and public markets, like public markets, you actually get all the data like of how the company's doing. Private markets oftentimes are shitty because you don't know how a company's really doing. And you have to kind of like read the tea leaves on it if you're not a Sacra subscriber. But so I thought this was an interesting thing in terms of the stuff we've talked about, like of companies being more open with what they're doing and sort of trends in that direction that would lead to like more liquid private markets. And again, another step away from IPOs, which I'm the mid-twit on that here.
I love Alex. I think he's amazing.
But off camera, Peter.
But I mean, I just see no reason why the hell VCs would do this for founders. Like, the founder wants to do this. Founder should do this. Like, sure, easy. I mean, if you like, the founder can hire a ghostwriter. Like, it's not a reason to choose a firm over another firm. Obviously, the other thing is like this is happening, and I don't think that. I don't know. You all tell me. Like, I follow 3 founders, I think, that do this every week, where they're like, "Here's my churn numbers. Here's my growth. Here's blah blah blah." I don't see very many founders doing that. Just if only because like it works for certain specific kinds of businesses, I think, but for other businesses, like the point of being private is not to do that, so that you have time to work through mistakes. Like it just seems antithetical in some ways. Like I know Warmly and RB2B and stuff like that do this kind of stuff. And it's like, yeah, for a couple people, I think it's cool. And it's a cool content stream for sure. But in general, I just don't see this happening.
I agree that I don't think it'll happen. And I agree, I don't think this is like an actual value add from a VC side. Yeah. And two, I also agree that I don't see it happening for everyone. But I do think that they're both like similar to what we talked about on the directional nature of like the chart that Tyson was on, right? Like I think that directionally it is a step towards more transparency in private markets. Like these are all early stage companies, no one, like it doesn't really matter. But if the general trend is towards more transparency, then the general trend is also towards more liquidity. I think just as more people are familiar with the companies, but I agree that not all companies will do it. But even again, an uptick in some is more than none.
I think what we've learned today is that if they need to have 4 publications, the VCs need to have 4 publications. Then their top tier. 1 publication we've already decided not good enough.
Couldn't agree more. Actually, I think 4 is going to be weak numbers pretty soon. You got to boost those are rookie numbers, man. You got to boost that up.
Those are rookie numbers.
Those are rookie numbers. I feel like
what a fantastic Wolf of Wall Street reference.
The other thing here that's kind of tied into this, not on the promotional side, but on the, to your point, Adam, about liquidity, is like, take the topic of founder secondaries. Basically verboten for the vast majority of founders up until 2019, 2020, then became much more common for founders to take money off the table fairly early on in 21 and early 2022. And then, it's gone down, but it's gone down to a much higher level. Like the new floor is much higher than it used to be in terms of willingness on the part of other investors and other private market participants to be interested in and accepting of founder secondaries. I think every time there's like a secondary or liquidity boost, it might drop off when the boom ends, but it doesn't go back down to where it was. It's kind of like Bitcoin. Like it'll just stabilize at a new higher level. And I think that is definitely true, that this last 3 years is going to push people to find different forms of liquidity on an ongoing basis. And that might be wrapped into company planning much more for companies that are growing up now than it was before.
This is a whole, and I've been meaning to pick this group. And I think I've talked to each of you about this before, but the idea of like a new best practices for liquidity for companies as they stay private longer, and for like, it's very Wild Westy still, but providers like Carta, data like Notice and Sacra, allowing for companies to basically offer like liquidity timelines that are a little bit more realistic for, because I think it all goes back to the employee side. Like we're talking about founders getting liquid and stuff, but like, if you want the best talent to work at your company, the idea of like these shares are never worth, are like going to be worth something maybe in 15 years, like not a real pitch. And so I feel like that's a big driver. And a good, like actually really positive reason for it, rather than like, some sort of speculative reason where like, I want to be able to trade shares like as I see fit. Like, I don't think that's a good reason for private markets to grow up. But I do think that liquidity, in order to better incentivize the people that actually build the solutions, is like a real.
But the trick with that is to be able to pull that off, you need like continued investor demand that exceeds the company's capital needs, right?
Yeah.
Like you have to say, we're going to divert, hey board, we're going to divert X amount of money away from the company and into the pockets of our employees, and hope that A, they don't run away and buy Ferraris and drive off in the sunset, or B, we'll have enough demand next year to where we can raise, So it just becomes difficult, I think, if you're not one of a short list of names, to consistently say every quarter, if you're SpaceX, every quarter we're going to do a tender. It's like, okay, cool. But if you're not that, it's harder. I just think that's in 2021, it was much easier because there was just demand for everything, always, everywhere, all the time. And I just think it's hard now. It's so spotty.
To be honest, I think that this is going to happen for founders way before it happens for employees.
Totally.
For sure. I mean, I think it kind of generally, I think it does.
Sad to say that, obviously, but like
no. But I think it does, as you mentioned, right? Like it's just something that's way more on the table. Like it's not something you can't ask about. Like there was a period not so long ago when it was like really bad signal for a founder to ask. Like that would be something a VC would be like, yeah, I mean, we like the company, but he's trying to get liquid. Like I don't want to. When
I did my first startup out of school, like in 2000, whenever, I don't want to date I'm old, like in 2002.
1981, was it?
Yeah.
Off camera.
In 1896, when I started my first coal mining venture in it was like I had investors to my face. Like it wasn't even, dude, what's crazy is it wasn't even about liquidity. It was about your salary. Like they hammered us down on salary because the idea was you shouldn't have any extra money to like get distracted with anything. You should basically be able to afford pizza and then work. And like that, it was so opposite of what it was in 2021 and kind of where it is now. And so, yeah, obviously it's definitely getting better for founders. And I think it is easier to do liquidity for founders because they can kind of make it a deal term. Hey, I got these two things. I don't know. I kind of want some secondary. It's like, oh, okay, sure, we'll do that. And then he or she picks that. It's also a lot more expensive to do it for your employee base. You got 1,000 employees. If they want $100,000 each, it's like that's a chunk. I mean, I agree that the founders will see it come back first.
It's interesting. Kind of these trends of young founders. I've kind of heard two stories recently. of like two kind of contrasting things. One is there was like this sort of rise of like kind of like creator-esque founders who would actually join like YC so that they could make content about YC, because content about YC like performs really well. So like if you had like something that tracked like a day in the life of a YC founder, that like video type is like going asymptotic right now. And
you can just call Adam out, man. You can just like, I don't even make it, but like you can just call him out here.
And yeah,
say it straight to me, Walter.
But then on the flip, I was talking to an investor yesterday, and he was like, "Oh, dude, there's these there's like a rise of like these 996, 9 a.m. to 9 p.m. 6 days a week. AI AI is startups started by like 22-year-olds, 23-year-olds working in SF like." And the whole thing is like hardcore startup culture. And it's kind of like, this like kind of dialectic is interesting, but there's always going to be like kind of like both sides. But it's interesting too. Like this guy, our first engineer who Adam, who was, was on with Sam, he started, we hired him out of high school, and then he, worked at some startups, moved to San Francisco, and he raised like $1 million seed. He's like paying himself $30K a year. I don't know. And he's like 22, and he's not like, he's like from rural Wisconsin. I was like, dude, he like lives in his office. I don't know. You should go visit it. Yeah. He's like, his office also has an apartment and he lives in it.
Dude, I mean, this is like every week you read on X, like some 21 or 22-year-old founder posts something about how like, here's a job opening. If you're not like the most hardcore person, or actually, did you read? There was one recently on a really big company. Who was it? Oh, this was interesting. It was a huge Indian company, and they were hiring a chief of staff.
Oh yeah.
And they were like, "You pay us, like with no salary, like we're paying you in learning opportunities." Like,
Although that guy was semi-incoherent. I mean, his argument. He was like, "I didn't want you actually to pay me. It was a test." It was like, all right, dude.
It was
just like,
but like, yes. I mean, it's just like founder. I mean, literally founder mode as a lifestyle is back in the Valley. And like, just as there were people who were trying to get into YC to make content about YC, so will there be people who are trying to like LARP being founders so they can act super hardcore and then get like a bunch of attention for being super hardcore. Every new idiom will have its like fun aspirants who are like, "Oh, that seems awesome. Let me get into that."
It's not awesome, dude. It's not awesome. I put this background on like when we launched Notice, and people were like, "Oh, that's cool," and I was like, "I'm just trying to be honest," and they're like, "Oh yeah, no, totally." I'm like, I mean, no, I don't know. It's kind of tough after a while. Like you sort of need to take some breaks. Like
I've definitely had that conversation with, and I was definitely like a sleep on the floor founder, like straight out of school. I was like, this is how you do it. Get paid nothing. Like I literally had a mattress company and didn't have a mattress. Like, and I thought
that's pretty legit.
I thought that was like,
how could people trust you?
I'm doing the right thing. I'm doing the right things. And second company, a little bit better. And then by the time I was on the other side of it, and like we were on the other side with Sandhill and Stonks, and I'm talking to founders like, you have to like take care of yourself. Like you don't have like unlimited. I think that's like the happy medium of it, right? Where like there's a difference between like healthy grinding and like unhealthy grinding. Where like you just like, drink a day, don't sleep, like you're not going to be performing. Like I don't want your brain making decisions on like sleeping on the ground, not eating good food. Like the other side of it being like you can't hang out. There's just a happy medium, like is the real answer, right?
Okay, wait. So actual data points into this conversation. There was a back and forth between Sheil who runs the Mint and Better VC, and then some YC partners about founder vesting schedules. And I found this super interesting because Sheil was like, they should be 8 years off the top. And of course, the comments on the founders are like, absolutely in no fucking way will you ever get me to do an 8-year vest when I join a company. But then the VCs, I think, I don't know if fairly is the right word, but like replied with some logic saying, well, if you do a 4-year vest and you're fully vested by the time I do your Series A, I'm going to make you revest some of that money or some of that equity so that you still have upside over the term in which I am investing in your company. I don't know how either of you, Walter, Tyson, feel about founder vesting. Right now, the standard is 100%, 4 years, kind of basically the same as employees.
Yeah, I mean, I think one is it's important. The question of like co-founders is important, and you know, it does protect you as a co-founder if you as co-founders you have a longer vest, and you know, not many co-founder pairs make it the whole way. You know, like a lot of times, one of them becomes the main person, and the other one gets
released back into the wild.
Exactly. Thank you.
Ask to leave.
Yeah. So that's pretty typical. So I don't like. I think it's a multi. I think it's like not necessarily investors versus founders. It's a multi-dimensional question. But I think like in reality, in sort of reality, it takes a long time to build a valuable company, and every step of the way, like often takes a different set of people, in founders and investors, and employees to like get from level to level. So I think like longer duration makes sense to me, but I'm speaking as someone who did a 4-year vest, so like
I did a 1-year vest with a 30-day cliff. I'm feeling pretty good about that. Yeah. I think it's interesting. Like there definitely are dynamics. I've seen cases plenty. I'm sure I'll always have where like one co-founder leaves with just a massive chunk of the company, and it's like, like especially if the company's trying to pivot or has a hard time and like whatever. Like if everything's going swimmingly, then that's fine. But if it's not, then it can be tricky. But at the same time, like if you are a founder and you have a huge interest in the company, like your interest is to stick around and I mean, if you're the main person, especially to like make it be valuable. Otherwise, I raise this big round and peace out. If I don't think I'm helpful, then I guess, but that's kind of a weird against your own interest move if you really think that you are somewhat relevant in making the company. Jason Turner in the comments says 4 years with a 2-year cliff. He's advocating for a longer cliff. Maybe that's interesting. I don't know.
Yeah.
I'm interested. One, it's I think just interesting that it's like it's like a new negotiation point, because it's one of those things that was just kind of standard. Like it's not like a list. It's not like on the list of things to be discussed. It's just like this is one of the things that's been figured out. But let's talk about valuation and ratchets or whatever. Whereas it's interesting that that's like a new negotiation point where it's like, hey, like we'll maybe up the value here a bit, but you've got to give us some on the vesting schedule side where you're gonna like have a long. Yeah, I think one of the interesting parts about these types of things too, though, is and I feel like this on the secondary side a lot of times as well, where it's like if it's a life's work founder, like it's like it's their thing that they're doing, and like you're making a bet in that direction, then it doesn't neither of those matter really, right? Like and if you're worried about the founder ditching, then like maybe that's like a big flag, like whole investment, right? It's almost like this like if you're in this conversation where like, hey, I think you might leave after 4 years, then like what are we talking about?
Yeah, that's a good point, man. It's a really good point.
Like, anyways, right? Like that becomes interesting. It's a kind of downstream from that, and whatever. It's getting more.
I guess the other question is like how many founders or founders that you would really want to have invested in, successful founders, how many of them are sticking around because they still have shares unvested?
That's
the question, right?
That ends up being my point on the secondary side, where people are like, oh, well, we can't let them sell secondaries because then they leave. It's like, what? Like, this is like their life's work thing. Like, they need to be poor to work hard. Like, what are we talking about? Like, that's not true. Like, not for the Navy.
It's like telling investors they can't charge management fees. You can't charge management fees because then you're not going to be incentivized to get carry, you know,
Exactly.
and carry is kind of how we're aligned. So like, how about no management fees and then just all carry? Does that sound good? How about that?
That'd be a great rebuttal by a founder. That'd be a great.
How about that? That'd be great. I mean, no management. How about half the management fees? How about that? No problem.
We're coming up on time. We're coming up on time here. The last thing that was kind of on the docket, and maybe just good information for people, we can get some commentary from everyone, is the YC move, which had happened a while ago. I think it happened 2 months ago. The news came out that YC was going from 2 batches to 4 batches. The subtitle is that they're not increasing the number of companies, they're just spacing them out more, right? So like the last batch, the summer batch was 250 companies. This fall batch is 125 companies. And they've noted that they plan to, rather than having 250 company batches, they're having 4 125 company batches across the 4 seasons. From what I know, terms are the same. The other interesting part is that their demo days back in person. So they're like pulling that and the last kind of data point to share is that they used to advise founders to not start their fundraising conversations until maybe a month before demo day. It was like, and they have like kind of prescriptive, like, don't talk to investors until this date, like this, whatever. For this batch, the smaller batch, it's a shorter window from what I can tell. Like founder conversations just started yesterday, and demo day is it next week? It's like, I should know this off the top of my head, but it's either next week or the week after. So it's like, it seems like they're kind of pushing people. It's next week. They're pushing people to demo day investing a little bit more. Whereas like in the last paradigm, it was like everything's pretty much wrapped up by the time demo day happens. But yeah, have you guys been following this at all, or thought about the Y Combinator, or I guess what are gut reactions to the change from 2 to 4?
I think it makes sense.
Feels like a good way to stay in the news.
What'd you say, Peter?
Feels like a good way to stay in the news, right?
Yeah. I've definitely thought about it. We talked about, I think Walter and I talked about that, where it's like it's just kind of happening all the time now.
Yeah.
Like there's not a down period, both for investors that focus there and like mind share on the investor side, and obviously like the media cycle as well.
Yeah, speaking of staying in the news, one of the things that's interesting is like YC is becoming a pretty big media, property. I mean, just connecting back to our conversation about YC. I mean, YC is plausibly like, because A16Z kind of like, with Future and all that, they like gave up a little bit on some of that, but YC's like YouTube channel is massive, and they have Hacker News is probably the biggest tech community online, and then they have all the YC, their SEO spam, a page for every company, like all the lists and stuff. I'm guessing their ycombinator.com drives millions of visits on a monthly basis.
This has been this is like Gary, like you think about like the reign of Gary, like Gary in the driver's seat, like he was obviously a big YouTube guy, and I remember seeing like early on when he had come on board, like even like the YouTube thumbnail changed. Like it went from like YC having like shitty, not YouTube optimal like thumbnails about niche startup topics to like they actually like fully play the YouTube game. Like the library used to be very like ycombinator.com native, like, and all the content would just be on that site. Now it's very much like pushes you out to YouTube. It's very YouTube native. Like they've made clear, like dominate that space. And again, Gary being like the one leading it. One of the interesting thoughts that I had about it was that how much harder the partners have to work, because you used to have like twice a year, like you're on for 6 months of the year. You're not in batch for you're not in batch for half of the year. It was like it's like a professor job. Like you get your summers off, but but now like it seems like a clear pace push from Gary, which is like they were already winning accelerators, and now they're like even going harder, which is I thought interesting.
I'm off camera, but I am playing a violin for all those YC partners.
I'm just looking out for those guys. All the YC partners that are watching.
Adam,
like, I'm on
it's
their
okay to
side.
not be a shill all the time, you know?
They just work as hard as their founders. I mean, that's really what it comes down
That's
to.
right.
Guys.
Founder
I mean,
mode, but on the investor side.
investor mode.
Investor
you know,
mode. Yeah.
like fleeces and lift tickets. It's no big
Investor
deal.
mode.
It's all good.
I love it.
Well, guys, we're at time here. I don't know if anyone has any parting comments, but that's it for me, and I'll let everyone get back to their day. Good.
This
All
was
right.
fun, Tim.
Thanks, everyone.
I'll pull everyone down. I'll put this up.
All right.
Bye,
right.
Peter.
See ya.
Wave off camera, Peter. Wave off camera.
I'm waving.
Bye.
May your Wi-Fi continue to be minimally viable.
Exactly.
Founder mode Wi-Fi.
Founder mode.
Founder mode Wi-Fi.
Later.
All
y'all.
right. See you guys.
Yeah.
All right.